Hello and welcome to Market Watch. Happy new financial year. FY20 is here and it's going to be quite an interesting year indeed. As we go through July and look clearly into August, earnings season is going to come into sharp focus over the next 6 to 8 weeks. And it's very interesting in terms of what we see around that space. If you look at what expectations are for FY19 reporting, the back half of the financial year was pretty lax, and it's probable that it will drag on EPS. It's also likely to drag on net profit. If you have a look at the industrial space particularly, the downgrades have been across a whole range of things. There's no one area or sector that you can point to that's pulled into that. So keep an eye on that. That's certainly what it is, but the market is ignoring it, and it is clearly looking to two things: outlook statements, and then again, it's all around monetary policy and the fact that it is going to filter into risk. It's going to filter into equity markets over the next 2 years. And FY20 could be quite an interesting year in terms of that inflection between what actually happens in terms of stimulus, what happens therefore in momentum, rather than what actually happens in bottom-up movement and the value that comes with it. And therefore, let's start of what is going to happen this week. We enter the 2-week period that is central bank period, and this July has become even more interesting now that the Fed is in play. As always, have a look at the charts behind me, have a look at the charts that I'm playing with on my screen. I've shown you this many times. It's one of my favorite things to give you a look at, which is the interest rate probabilities across the central banks across the globe. And let's start at the top and have a look at the Federal Reserve. You can now see that they have switched as well, and the probability of the most likely scenario of movement in this month is now a cut. And that in itself is astounding to see. If you look at what happened at the start of the year, if you looked at what was there, the most probable thing was actually to see possibly a hike in the first half of 2019. Now we're talking around a cut. And I want to really drill into the fact that it's sitting at 78%. And this is only off the back that last month, not even the quarter before, last month, the Fed finally downgraded their expectations to see one rate cut by December 2020. Not even this year, one cut by that. But the market is running away with it. And I've shown you this before. I therefore really do need to show you, and drilling into that, have a look at the implied interest rate to basis points over the next basically 6 to 8 meetings that we need to look at all the way through till June 2020. By this time next year, the federal funds rate is expected on what they call their target rate. So that's the middle of their band. They actually work in bands. So it currently sits at 2.25 to 2.5%. They believe that the central band will be at 1.4. That means, as you can see, the basis point decline is 94 basis points. They expect 4 rate cuts by this time next year. And you can see they expect to see a rate cut coming up at the next month. They also, therefore, looking into September, are suggesting that there will be another one by the September meeting, and having the target rate sitting at 1.86, which means the whole band would be at 1.75 to 2%. And that is a very interesting conundrum for not just the globe, but for us here in Australia. Part of what our RBA has been begging the central government to do is to actually get on and stimulate our economy. Fiscal policy is very much part of that idea. It can be a here and now movement rather than the fact that interest rates take time to actually filter through, to actually make you more confident to go and buy and consume more, to look at a new house, to look at investing in the market. But why I say that is that this brings in the Aussie dollar, and I want to really show you this chart here. So this is the Aussie dollar versus the US dollar. And why I want to show it to you is that when we talk around the Aussie, we sometimes forget that it's not saying this is what the Aussie dollar is worth. It's actually, this is the Aussie dollar worth against the US dollar. We don't talk around our trade weighted basket. It's where it's more along the lines of around about sort of 65 to 67. We always talk around it in terms of this. And this here is against the US dollar. And have a look at the movement that has happened basically since the middle of June to where we are now. It's gone from being as low as 68.6 to now being into the 70 handle. We're back in the 70 cents. And that's why last week you actually saw Philip Lowe say something very clear, which is that all of what they're currently doing will mean nothing if they can't actually keep the currency low, because if all central banks are moving together, all of the actual positive impact of having the ability to get better intake for your exports is completely nullified, because everybody's going the same way. And that chart shows you that. you can see very clearly that the Aussie is on a tear, not because of what's happening here domestically, it's because of what's going on over in the US. And that's why I wanted to show you what happens at the Fed. It's not against just the Aussie. If you have a look against the pound, the euro, the yen, also the Swiss franc, the US dollar is falling and falling at quite a rapid rate. That'll certainly make the president very happy. It's certainly something he's very concerned about. He's even started talking around currency manipulation by the ECB, for example. But if the US dollar does fall, it starts to make things just that little bit harder on our export front. Part of the reason why, although we've got fairly slow GDP, we've held up because net exports have been better. It also puts into the chart frame that what we've also forgotten is that, don't forget, we are a commodities-led currency. We are a commodities-led economic sort of mover, and the iron ore price is well and truly going above where anybody thought it. It hit 124 US a ton last week, and that shows you that, again, the return we're getting is much, much better. So that is a positive, but it's also driving what's going on in the currency. Which brings me to what happens this week. Tuesday, the RBA now has, and you can see from what I want to show you on here, the probability of seeing a rate cut on Tuesday sits as we speak at 78.1%. It has been as high as 82%. So it's more likely than not to happen. That would be the first time we've seen back-to-back 25 basis rate cuts since the GFC. Although I would put a caveat in there, in 2012, they did actually cut rates once by 50 basis points rather than doing two 25s. So there is some part of that in there. What is getting more fascinating is if you actually have a look at what is inside the August, September and October numbers, is that that's actually come back in. And what I mean by that is that if you had have looked at that chart and looking at this implied rates to basis points last week, it was actually showing a probability of seeing another rate cut in August at sitting at around about 70%. That's now fallen right away. It's nowhere near that level. It's now sitting at 47%. That would have been the first triple cut in a row since the late 1990s. And that is something that would have been quite fascinating to see 75 basis points out of the cash rate so incredibly quickly. I then want to bring you down to these charts here, and that is the implied versus the actual, and then the historical implied basis points. You can see the market is a little bit all over the place, but I want to concentrate on this line here of the implied. We are sitting at 106 for next week. As I said, that gets you into it, but you can see that the market has been chasing itself. And it's really taken off since around about March, when we started to see the idea that unemployment was starting to tick up. Participation has been fantastically strong, but that therefore means despite the employment growth, which has been very, very robust, for every one person into a job, one person returns to the market. And it's more likely than not to see the unemployment tick up, which is why if you look on the far side and look at the historical numbers, I want to concentrate on this one here. The 6 months to date shows that by basically the end of the year, there is expected to be 57 basis points out of the cash rate. Now, as I speak, we haven't seen the one that's likely to come this Tuesday, but it means by the end of the year, it's probable we'll see another one. So does that mean, as always, the Melbourne Cup Day is always one people point to? Historically, Melbourne Cup Day tends to be a day the RBA likes to move, and it therefore means that by the end of the year, the market still believes that we will have a cash rate in this country at 75 basis points, or 0.75 of 1%. And that therefore is, again, trying to basically push up and making sure that employment grows to push down unemployment, push the Aussie dollar down and trying to become a little bit more competitive on our exports. And therefore, all of that is about probably also propping up business confidence and business spending. Something I will talk to you about over the next couple of weeks is that the US-China trade war, the biggest fallout for that has been business spending and CapEx spending. Future intentions around capital expenditure from business has been severely impacted by that. G20 has obviously been, we've seen what Trump and Xi have said. Again, it's an interesting one because it's not over yet, and that's the way to look at this. And that is why I want to look at this over the next couple of months, because if business CapEx doesn't return, all of this is a bit of a moot point, because bottom-up earnings, although they might be impacted positively by having stimulus, businesses just aren't confident enough on a longer-term view to invest, and that is going to be the key crux going forward.